Thank you. Thank you, Mark. Thank you, Don, for that introduction. Thank you, everyone, for being here, and those of us on Zoom land and maybe watching the video later. I'm thrilled to be here today, and we're going to talk about some of my favorite things, which is real estate taxes. Let me grab the pointer. So as they indicated, I'm a real estate attorney, real estate broker. I've been a real estate attorney for a little over 20 years, real estate broker for over 15 years. In my practice, it is exciting because I get to see some of this on sort of the front lines. Obviously, we all deal with real estate. We all deal with some of these topics. Thank you so much that we're going to be talking about. But more recently, we're with Coldwell Banker Global Luxury, and it's kind of fun because we actually get to talk to people about some of these things and see how the real world reactions are. Some people, for example, not selling their houses because of tax considerations and things like that we'll talk about. We do have a disclaimer, obviously standard disclaimer, just because we're gonna go over things, we're gonna try to go over a lot of material that's not a substitution for proper legal or tax advice. So please, before making any of these kind of strategies or doing any of these things, consult with your own professionals or look into it a little more in depth. But we do have materials that have some guidance. There's like 2 pages worth of citations. So there's a lot that we're gonna try to cover. I wanted to go over Prop 19 because that is a huge tax thing and that's near and dear to my heart. We've been dealing with that for the 4 years, but because I know that's kind of been beaten to death and I think a lot of people are familiar with it, we're gonna save that till the end and see if we have time and then go over some of the things, including the LLC workarounds and some of those kind of fun things that are floating about. But what I really wanted to talk about was more of the selling the real estate, the gifting of real estate, which we do a lot of, the sort of the hybrid, the gift of equity, capital gains, step up, the IRS 21, 1031 exchanges, we're all kind of familiar with, but we'll talk about a few nuances that we get to see in our practice. And then some of the more fun, advanced things. Installment sales, we actually had a presentation last month on deferred installment sales. We'll talk about that very briefly. Opportunity zones, bonus depreciation, real estate professional status, some of these other kind of more nuanced tax things that people are really taking advantage of that can be enormous. And then we're going to talk about what's on the horizon. As you've all seen, there's a big, beautiful bill that's been passed recently by the House. And so we're going to talk about what that's going to do to real estate. Obviously, still a lot of changes in store for that, but it could be significant. So we've got, there we go. So we're going to talk mostly about some of my favorite topics, which are death and taxes. By the way, death, really one of the main reasons why people are selling real estate. In case you haven't noticed, people don't move up and buy bigger homes anymore like they used to. It is really when people die that a lot of real estate comes for sale, at least certainly in our markets in Newport Beach, Costa Mesa, Laguna Beach, things like that. And there's a lot of reasons for that. But death is it's a huge driver of what people are doing or the reason for people selling real estate. And just like death and taxes, people do try to cheat, of course, both of these things. So we're going to talk about some of the things that we can legally do to deal with some of these things. So the first thing I want to talk about that we deal with a lot with is gifting. And that obviously we're all familiar with gifting at death, right? Someone dies, they leave a property in a trust, things like that. But a lot of times we deal with below fair market sales, gifts of equity, children buying the property. And I want to talk about the annual exclusions and the lifetime exclusions because I think there's still confusion about this. And then we'll talk about how some of these things come into play with these situations. So first of all, the most important thing to keep in mind, there's 2 different numbers. And I think these things really get confused very often. There's a $19,000 annual exclusion, and then there's this nearly $14 million lifetime exclusion. Those are different. Basically, the easy way to think about it is that if you give someone $18,000, the IRS doesn't care. You don't have to tell them about it. Okay? And that can be an enormously powerful tool, especially if you have a lot of wealth you want to transfer, because each person could do it. So I could give daughter $19,000. I could give son $19,000. My wife could give daughter $19,000. My wife could give son $19,000. All of a sudden now we've transferred nearly $80,000 a year that we don't even have to report on our taxes. So this for high income people, they do this, they use this strategy. It can also be used in property, give away 1% per year. People try to play those types of games too. Those can have assessment consequences that we'll talk about with Prop 19. But that's the meat of it. And there's a lot of confusion. Well, how's that different from the 14,000 or the 13,999, which is the highest it's ever been, by the way. So that's what you get all the way up to until you have to pay any taxes. So let's say you pass away, you've got a $10 million estate. Let's say you've got a nice house, you've got gold bars, whatever lying around. You leave a $10 million estate to your children, you're paying 0 taxes on that, 0. It's only up until the estate exceeds this $13,999 amount that then you're starting to pay the inheritance tax, which can be significant. Now, this is a huge deal. I mean, this was not like this in the 80s and 90s. I'm sure we've all looked at client trusts and we've got these like giant, 50-page trusts that have like A/B trust and pour over trust and all these things. That was all like a big strategy to kind of deal with the much lower allowances back in the day. But now with these amounts of money, that's most people's estate. Let's be honest. I mean, here in our market in Newport Beach and stuff, we've got houses that are worth more than that. So there's certainly plenty of people that are going to have inheritance tax. But for a lot of people that own a house and have some investments, there's essentially no inheritance tax. And we'll talk about what's in store for that with the current bill. So one of the things we do a lot with, can I sell my house to my child or anyone below fair market value? And can you do a gift of equity? The answer is, of course you can. And there's still a lot of confusion on this. We get people that say their CPAs told them something different, or they read on the line that they can't do that. So we'll talk about how this works. So of course you can do it, but the trick is that, or not the trick, just the reality is that there's a part then that has to be reported. So for example, so this just kind of says, yes, of course you can do it. So what's the gift? So obviously it's just the difference, right? So if the home is worth $2.8 million and you want to sell it to the child for $1.8 million, well, you've given a gift of $1 million. Simple. You have to report that gift, but since it's under that 13.99 million, there's going to be no taxes due on it whatsoever. So people still come to us with a lot of confusion on this. Maybe you've had similar experiences. People are like, oh, but I can't sell it below fair market value. That's illegal or something like this. But no, it's not. As long as you're reporting it, right? So that's the key. You got to report it to the IRS. So if you just sell the house below fair market value, try to pull a fast one because you don't want it to count against your allowance or something like that, well, that's a no-no. But as long as you report it, you can sell that house for $1 million for $1, right? I don't know why anyone would sell it for $1, but people ask that and they Google it all the time. Can I sell my house for $1? Yes, you can. You just need to then report the difference. Very simple. This also then gets used a lot, at least in our business, with a gift of equity. So let's say the parents are going to sell the property to the children, but maybe the children don't have that enormous down payment, right? Maybe $400,000 in our hypothetical here of a $2.8 million purchase. Well, we can use this delta, this gift, as essentially the down payment. So assuming the child can otherwise qualify for that loan, like the $1.8 million, we can basically get a $1.8 million loan. The lender says, well, hey, there's plenty of equity in the property, so we don't need any additional down payment, and we'll allow you to use that down payment as the gift of equity. So this is a great strategy that we use a lot, and because sometimes the parents do want to sell it, right? Obviously, if they pass away, it's left in a trust, they're inheriting it, but a lot of times people want to sell it. Maybe the parents want to cash out and move, and they'd rather sell it to their kids than a stranger. Maybe they want to go on that worldwide cruise. Maybe they need the money. Maybe they're downsizing or something like that. So this happens a lot where the parents are actually selling it, but rather than sell it for the full value, you give the kids a break, you help them with the down payment, and then as we'll talk about in a second, it can really help offset some capital gains too. So you can use this strategy to avoid or minimize the capital gains. So let's get into that. So when we talk about the capital gains to the giftor or the person selling the property, so normally in that hypothetical, right, I think I've got a hypothetical here where they bought it for $100,000, now it's worth $3 million. This is not a crazy hypothetical. We see this all the time in areas like Newport Beach. That's enormous capital gains, right? That we'll talk about those numbers in a second, but that's enormous. So let's use a hypothetical. We'll talk about these allowances in a second, but let's just say, you know what, we're just gonna sell it to the kids for $600,000. We just wanna make some money off it. Maybe we've got a small loan, maybe we just wanna take a cruise, so we'll sell it for $600,000. Well, we've got the $500,000 exemption that we'll talk about in a little bit. And basically now we sell it for $600,000, but we've got the $500,000 exemption. So we're not making any money on paper, right? But I've just put $600,000 in my pocket. And I don't have to pay any capital gains on this because we're under the amounts. Now I got to report the delta as the gift, right? So we're going to report the difference. But this is an enormously powerful way to get cash out of a property, maybe pay off a loan, like I said, get the parents some money, but then also avoid capital gains. So very frequently we're kind of playing with these numbers to figure out, okay, what's the most amount of cash that you need versus what's the littlest amount of capital gains you want to pay. And you can kind of really fudge these numbers to come to that perfect little thresholds. And as we'll talk about in a second, obviously there's other things that you add into this, any sort of expenses, improvements, things like that we'll talk about in a second. So this is then a question that comes up a lot. We'll talk about the step up in basis that I'm sure most of you are familiar with. But what happens when the person's gifted it? Well, there is a special rule, and it's basically the greater of the two numbers. So for example, in that situation, we go back to that hypothetical where the parents bought it for $100,000, but they sold it for $600,000. Well, the child's new basis is going to be that $600,000. Here's some examples. It's going to be the lesser of the two numbers, which totally makes sense because if you think about it, that way no one's cheating taxes. The capital gains is still going to be due if the child eventually goes to sell the house. But you can get a benefit, or the child could actually be worse off if the number is greater. So let's say, for example, we just did one of these where the parent actually bought it for $3 million. They bought it today or a little while ago, whatever the number is. So their basis is actually really high. They sell it to the child right off the bat for a lower number. Well, the child is actually getting the higher number. So they're sort of getting a benefit in that situation, but that's fair, right? Because even if the parent were to sell it, they would only pay taxes based on their basis. So if you think about it, it kind of makes sense, but we do get a lot of confusion on that as far as what would the child's basis be then when they go to sell it. Which is sort of a perfect time to talk about the step up in basis. So I'm sure a lot of us are familiar, but whenever we talk about these sort of gifting things, the question is always, do you really want to gift it right now? Or do you want to wait till someone dies? So obviously we understand why people want to do the gifts now. Like we said, maybe people need to cash out. Maybe they want the kids to move into the house, raise the grandkids, things like that, let the kids start building up some equity. But any way you cut it tax-wise, you're usually better off at death. So in its most simplistic terms, the fair market value at the date of death is the child's new basis. So if a child inherits a $3 million house, let's say it's worth $3 million at the date of death, it doesn't matter that the parents bought it for $100,000. The child's new basis now, if he turns around and sells it, is that $3 million. So they're going to pay no capital gains. So when you look at the high inheritance tax allowances and the step up in basis, you can basically have situations that happen all the time where a child, for example, is inheriting a $3 or $4 million house. Well, there's no inheritance tax or estate tax due on that because it's under the limits. And then they're able to turn around and sell it at that fair market value around what it was at the date of death, and now they've avoided capital gains tax entirely as well. So some people don't realize how powerful that is. I think a lot of people do, but some people don't. Now there is something that does get people in trouble that we see a lot, and especially if you have a real stickler CPA. There is a big difference with California being a community property state. You need to make sure that the property is titled correctly to get a full step up upon one spouse's death. So for example, typically if you own a property with your spouse, you've got it in a trust, or you own it as community property with right of survivorship, if my spouse passes away, I get a full step up in basis. I can now, as a living person, sell the property and essentially pay zero capital gains taxes because my spouse died. So you're kind of getting a 100% benefit even though only one of you died. However, if you have the property still titled as joint tenancy, for example, or tenants in common 50-50, you're only going to get a 50% step up. So we've seen this where very wealthy estates, the people pass away and just for whatever reasoning, they never got around to a trust, or for whatever reason, it was still titled as joint tenants. And that's obviously enormous when you think about the only getting half of the step up basis as opposed to the whole one. So pro tip for any of you have your clients, if you ever see your client's trusts or if you ever see your client's title on their property and you get the opportunity to talk to them about it, make sure they've either got it in a trust, which calls out that it's community property with right of survivorship essentially, or make sure that it is community property with right of survivorship. Some people might not want that outcome. Maybe it's a second marriage or for whatever reason they want it a different structure, but just know then that they're not going to get that full step up, which is enormously important. So we've gone over some of those examples. We've got some more in there. What about Prop 19? Well, so that's kind of a kicker too with the gift, right? So let's say we're selling to the children below fair market value. People always think like, oh, well, I'll sell it to the kids for $600,000. Therefore, they're only going to pay $600,000 in property taxes when the county goes to reassess it. And no, that's unfortunately not the case. The county has always had the ability to look at what's called the fair market value. Usually it's the purchase price in like a fair arm's length transaction, but not always. We've had people that have even bought properties on the open market and the county comes back and says, no, you got too good of a deal, or maybe they were playing a game with furniture or something that people do. But so, in those hypotheticals where it's like, oh, I'll buy the $3 million house for $600,000, you're still probably gonna get that reassessment. And hopefully we'll talk more about Prop 19 in a second. Can I finance a sale with a family loan? Absolutely. So then we do this with family loans too. So especially if you don't have that loan to pay off, or if the loan is just a smaller amount, then the parents very frequently do like a carryback loan. So maybe the parents don't need all of that cash up front. They can do sort of their own installment sale. You can absolutely loan your kids money. There is a rule, it's called the applicable federal rate, and it changes every month. You can Google it on the IRS site, and I think we've got the citation in there. It's well below market rates, but it's not zero, right? So if you charge your kids like a 2% interest rate, that's not gonna work. That's basically a gift. But I don't even know what it is this month. Let's say it's like 5%, but a real rate if you went to Bank of America or something would be like 7 or 8%. So you can still give the kids a bit of a discount, better than they would on the open market, but it still has to be a decent amount to be able to avoid it being a gift. You could do a 0% interest, right? But then it's just a gift. So then you're getting kind of complicated, and now you're reporting the gift of what would have been the interest and kind of this weird delta. When you do these, you've got to make it formal. There's some recent case law on that. I know the family law section just recently did a big update on this. Because for example, let's say you do a loan, but 2 or 3 months in, you decide, nah, don't worry about paying me back. Or you realize, oh, my son's a deadbeat and he's never going to pay me back my loan. At some point in time, that loan can become a gift. And then you do need to then report it at that time once it becomes the gift to make sure that you're not going to run afoul of that. Because otherwise, if they find out later, then you could have all sorts of interest penalties, stuff like that. Okay, this happens all the time. And this we've had debates with CPAs over. So if we're doing this hypothetical sale to the children at below the fair market value to get a loan, very frequently, even though we talked about that gift of equity being more than enough money to offset any sort of down payment, a lot of lenders still have like kind of the smoke coming out of their ears, right? They don't understand. The higher ups will eventually, if you say gift of equity and your mortgage broker doesn't know what you're talking about, just ask to speak to their boss. Because everyone can do it. But a lot of times, because they're still very old school, they want to make the loan based on 80%, for example, of the purchase price. So even though we actually want to sell it to the kids lower, like in this hypothetical, we want to sell it to the kids for 1.8 million. The value is 2.8 million. I want a $1.8 million loan. Well, I unfortunately cannot present a $1.8 million purchase agreement to the lender to get a $1.8 million loan because they're not going to give me a 100% loan. Makes sense, but it's frustrating. So we have to basically make the purchase price a much higher number for the sole purposes of not confusing the poor underwriters that are reviewing the loan, right? So we make the purchase price in this hypothetical $2.2 million. Now the underwriter sees that we've got this $400,000 gift of equity. It's going to show up as a line item on the purchase agreement. It's going to be a line item on the escrow statement. Now the lender's happy. They don't care what the fair market value is. I mean, presumably the appraisal is going to come in at a high number. They're going to be happy, no down payment required. But now we have this very pesky situation where I, as the parent, am now getting 1099'd for a $2.2 million sale in this hypothetical, but I've only actually gotten $1.8 million. I've had numerous people come to me that say, my CPA made me write 2.2 million and pay taxes accordingly on a $2.2 million sale. I think that is dead wrong. And I don't know why there's confusion on this, because if you think about it, it makes perfect sense. So the IRS talks about the amount realized. It doesn't say, what were you 1099 by the escrow company? It says, what was the amount realized? So I tell clients, write $1.8 million on your taxes. It's that simple. You're also going to have the Form 709, the gift form, that's going to show that $1 million gift. Now I've got a nice clean paper trail that lines up. Yeah, I've been 1099'd at $2.2 million. Thanks, escrow company, but that's what they have to do. But I'm also going to get a settlement statement, closing statement, that's going to show a line item, gift of equity. It's going to show that the amount realized is only that $1.8 million. Why on earth would you tell a client that you need to pay an extra taxes on $400,000 worth of gain? But I've had numerous clients come back just later and say, oh, my accountant says I have to do it this way. They're wrong, get a new accountant. So this comes up a lot. They say, oh, well, won't the IRS see the mismatch? Yeah, they will. And maybe that's a red flag. And maybe now you're at some sort of risk of getting an audit. So that's annoying. But at the end of the day, you're right. And anyone that tells you otherwise, I think is wrong. Because again, you can prove it. I only got $1.8 million. It's a fact. I'm not cheating taxes. That's what I got. And that's what the escrow company's settlement statement says. So again, you think about it, it's show me the money, right? Where's the money coming from? The money is the $1.8 million. Why on earth would you pay taxes on more than that? All right, that's an important thing I really wanted to talk about. Okay, capital gains. I think we all kind of understand the big concept here. If you make money, you have to pay taxes on it. So you buy a $100,000 house, you sell it for $1 million, you've made $900,000. There's some nuances that we'll go into a second. Capital gains rates for 2025 are good. They've been creeping up. So if you're married filing jointly, it's either 0%, 15%, or 20%. These are kind of the current brackets. No talk so far about changing those in the current bills, but we'll talk about that. They kind of adjust for inflation-ish. But it's a little misleading. So this gets people in trouble a lot. The capital gains, even though you're only paying the capital gains rate on the capital gain, what bracket you're in is determined by your overall income. So let's say you sell a house and you make a $500,000 gain, and you're like, great, I'm only in a 15% bracket. Perfect. No. Because if I made another $200,000 that year in ordinary income or some sort of other investments, the IRS says, well, you made $700,000 this year, therefore you're bumped into that 20% bracket. So I'm only paying on the capital gains at that amount, but it is kind of frustrating. And a lot of people think, oh, I only made, $300,000 selling my house, but I also made, a lot more money, especially if you're married. And then it can bump you up into an annoyingly higher tax bracket. So that's something we see a lot that gets people in trouble too, or they don't consider it. But that's not all, right? Don't stop there, folks. So we've got 20% on the federal level, but now we've got a net investment income tax, AKA the Affordable Care Act, AKA Obamacare. That's going to add an additional 3.8% on the married couple of over a $250,000 gain. So now we've gone from 20% to 23.8%. That's big. That's almost a quarter. But wait, there's more. Don't forget, we live in California. You're going to get shaken upside down by your heels. The highest bracket in California, it's technically 12.3%, but that's a misnomer because then there's an extra 1% for mental health care. And then there's actually an extra 1.8% payroll tax too. But luckily you don't pay that. So the most when it comes to real estate is 13.3. California does not recognize capital gains. It has no different brackets for capital gains. So you're just going to pay taxes on as if it's ordinary income. So in that hypothetical where you sold or you made a $500,000 gain on the sale of real estate, you made $200,000 from your W-2 employment or whatever, boom, $700,000. That's what you're paying taxes on. That particular rate isn't all the way up to the 13.3, but that phases in over $1 million. So, you got some of these people, you're selling a house, you're making $1 million profit, which is very realistic in our market. You're getting bumped up to that 13.3%. Now we're talking about 20% federal, 13.3% state, 3.8%, 37.1%. That is a huge number. And this is the reaction when we usually tell people about that. So now this is where the fun real world example comes in. So as the broker, we're telling people this and, it's like, oh, okay, are you interested in selling your house? You'll only owe $600,000 to the IRS. And the reaction is no. I'm going to stay put. I'm going to do that add-on. I'm going to build out a nice new downstairs living room. People are staying put. This is one of the many reasons why people are staying put, because those taxes are enormous, especially in our market. And I get it, boo-hoo, you've made $1 million in profit, but it's keeping people in their houses, which is then cyclical and deals with supply and demand and raises the prices of houses and all that kind of stuff. Okay, so throw me a bone. What can I do to avoid taxes? Let's talk about why we're probably here. What can we do to reduce the capital gains? So first of all, any sort of selling expense comes off the top, right? You hire a realtor. Those pesky realtors charge a ton of money. You've got title and escrow fees, plus capital improvements. And we'll talk about some of the examples, right? So improvements count, maintenance doesn't. So it's kind of a fine line. There's a whole list in some of these IRS publications. We've got some of them here and some of them in the handouts. But obviously if you added a 500 square foot addition to your house, right, and it spent $250,000 on it, well, you're absolutely adding that $250,000 onto your basis. Let's say you built a new ADU that cost $300,000. You're adding that $300,000 onto your basis, so on and so forth. Mechanical systems, HVACs, hardscape, pools, insulation. There's a lot of things that count. So, at the end of the day, someone that bought their house for $100,000 back in the 80s or 90s, they've probably spent a lot of money on their house over time. So you got to go back and recreate these things, which we'll talk about in a second. And then examples of what the IRS does count. Yes, obviously the sales commission, advertising fees, legal fees, maybe a hired lawyer. You can even go back to your original purchase. A lot of people don't realize this. There's some things on your original purchase that now you can actually sort of claw back essentially and deduct on your taxes from the sale. A lot of these are usually minimal because usually you're not paying the realtor fees or some of those bigger fees as a purchase, but maybe you did. Or maybe you hired a lawyer or some other things like that could add up, right? Throw another 10, 20 grand in there, it's that much less capital gains that you're gonna pay. So this is the question we get all the time, especially from the people that bought that house in the 70s or 80s. I've lived in my house 35 years. I have no idea how much I've spent remodeling this thing over the year. I did a kitchen remodel in 1995. I don't know what it cost. There's answers on this. And first of all, you better start looking, right? Dig through those shoe boxes. Try to find, obviously you're gonna get your closing statement on the sale, that's easy. Maybe you can try to find the closing statement on the purchase. Bank, credit card statements, permits, right? Maybe a lot of cities are online nowadays, or maybe you have to go down to the city office. Hey, do you have any permit history on file for me? Assuming you pulled permits to do some of that work. Photographs, this is my favorite one. I tell people, well, do you have a 1980s Christmas photo of what the linoleum floor kitchen looked like? And now you're looking at a brand new kitchen that you remodeled in 2000. Well, obviously you spent money on that. So luckily the IRS is aware of this. They allow you to use reasonable estimates. There's a whole test and there's some case law on this. Basically, it's a fine line, right? Obviously, if you get called out and audited, I call it kind of the straight face test, right? What can you prove? If you've got that photo of a kitchen remodel and you say it cost 20, 30 grand, probably. If it's like an okay kitchen and you're like, oh, I spent $800,000 on a kitchen remodel, well, you're just asking for trouble. So obviously this isn't a license to just, willy-nilly add things. But if you're that, like we had a couple that literally lived in the house for 50 some odd years in Costa Mesa. They sold, one of the very few people that sold without dying. They sold it and they moved to Nashville, which is basically the only people that aren't dying. That's what they're doing, selling and moving to Nashville. And they're like, literally 50 years in the house. They're like, I don't know. So we were, trying to help them kind of reconstruct things as far as what those original costs were. So, okay. There's good news. You're not just for waste. You can look it up. You can try to figure it out. Have someone help you do that. So the other biggest deduction for most people on the capital gains is this IRS Section 121. So everyone's kind of familiar with this, right? Oh yeah, I get $250,000 or $500,000 off my purchase. Some of us look at it as breadcrumbs in some of our high market areas. These rules have been in place since 1997, and we are still to this day running across people who do not know that the rule has changed. So prior to 1997, it was like a 1031 exchange where you could sell your primary residence, buy a new primary residence, and defer the taxes. It was a 1031 exchange for primary residences. That's not the case anymore, and it hasn't been since 1997. So we literally, even like a couple months ago, had an appointment with a past client of ours. They got divorced. We sold one house for them. We went to go talk about another house, and it was we sold their vacation house, and he thought it was his primary residence. They bought it for hundreds of thousands of dollars. Now it's worth $3.5, $4 million. And he's all like, oh, I've done this. And how much, we're all hot to trot about selling it. And I'm like, I just want to talk about taxes because I'm shooting myself in the foot and losing business by telling you, but you're going to have an enormous capital gains bill. And he's like, but I'm buying another primary residence. I'm buying another one. Like, sorry, it hasn't been the rule since 1997. So a lot of people still don't know this. And unfortunately, there has been no inflation adjustment since 1997. So that $250,000, $500,000 numbers, those were 1997, not pegged for any sort of adjustment, not pegged for any sort of inflation. They have not gone up, and they are not in the new bill that we'll talk about in a minute. So how do we get this 250 or 500? It's pretty simple, but there's some nuances and complications. Basically, it's a two-part test. Basically, you've got to have lived in it and used it as your primary residence for 2 out of the past 5 years. Now, some of the fun nuances to this, they come up all the time. It doesn't have to be consecutive. So maybe you lived in it for 2 years, you rented it out for 2 years, you moved back in for a year. That's fine. You've satisfied the 2 out of the last 5 years test. Maybe you lived there for 2 years. Now you've rented it out for 2 years and 11 months. And I say, well, you better close escrow in the next 30 days because once that timeline lapses, you're completely out of luck. We've got people that, oh yeah, I lived in it, but now I've rented it for 4 years. Well, you better move back in for 2 years then if you want the allowance. And people do that. So you've got to have that 24-month, but it doesn't have to be consecutive. It also can only be one spouse. So for example, if you have one spouse that's on title, maybe they owned it before as a separate property asset, maybe it was inheritance or something, but you can have one spouse on title, still get that full $500,000, but the other spouse has to have passed the residence test as well. So as long as both spouses have lived there for the 2 years, you're good to go. If you've rented it, you're still going to have depreciation recapture, so that doesn't go away. I think those are some of the nuances there. There are some exceptions, like everything, job relocation, military service, natural disaster, death and divorce we'll talk about in a second. But there are some exceptions, like if you get a job relocation, you have to move. You can get a partial benefit, so you're not completely out of luck. So there are some partial benefits. So if you have a situation that causes you to move, look into those partial benefits and see what you can get. There's a couple things we're going to talk about with divorce, and I think with Prop 19 too. This could be a significant factor, right, when you're talking about selling the house, because basically it's kind of simple and logical, yet can be unfair. Well, you have to be married to get the $500,000 exemption. So that's kind of what it comes down to. So if you're getting divorced, but you're still married, well, you can still sell the property and get that $500,000, no problem. But if hypothetically you get divorced and then you go to sell the property, womp womp, you're out of luck, and now you only get the $250,000. So if someone's going to keep the house as a buyout and keep it for years and years and years, great, it may not matter. But if you're going to sell the house anyway within a couple months or whatever, you darn well better do that while you're still married. In fact, we've had home sales that have delayed the finalization of the divorce because they want to make sure to get that full amount of money prior to the divorce. So it's like literally in the divorce decree, like it'll become final once you sell the house. So that's kind of something that gets people in trouble. And that can be bargained for. Obviously, if someone is going to keep the house, just kind of consider that, because then if you do turn around and sell it in short order, you're only going to get that $250,000. Death of a spouse, this one comes up a lot. Great news, so much good news for death. If someone dies, you can still get that $500,000 for the first 2 years. So remember we talked about how maybe you could get that full step up in basis, so maybe it's even kind of moot. But let's say you get the full step up in basis, you keep it another year, and maybe it was during COVID and 3% interest rates, and your property's appreciated another 20% in value. You can still then claim the full $500,000 for up to 2 years, as long as you don't remarry, and you still meet the other elements. But after the 2 years, then you're out of luck. Then it reverts down to the single $250,000 amount. So if your spouse dies and you are going to sell it, think about selling it within those first 2 years. Otherwise, if the appreciation exceeds the $250,000, you could end up paying taxes if you sell it 3, 4, or 5 years later, even though you got that full step up. This comes up a lot. What about selling a duplex or something like that? Yeah, you absolutely get credit for it. It's just sort of a pro rata amount, right? It makes sense. So if you have a duplex and you rent out the back unit, but you live in the front unit, well, you're not out of luck. You still get like a pro rata amount. And there's some, what's the word? Not funny business to be had, but some subjectivity to the evaluation, right? So, maybe you've got a front unit, but it's the Corona Del Mar front unit, so it's more valuable because it's the front unit, even though the back unit is bigger. It's not just a square footage, right? There's a little bit of art and a little bit of science to evaluating it. So in that case, you're definitely gonna wanna have like an appraisal, figure that out. But yeah, you can still definitely get a pro rata amount of the exemption for doing the multi-unit property, as long as you live in one, right? As long as part of it's your primary residence. If none of it's your primary residence, you're completely out of luck. Okay, I want to talk about a few things, but I kind of do want to get Prop 19 and see if we have any questions and answers. 1031 exchange, I think we're all kind of familiar with this. We've got some strict time limits. You got 45 days to identify the property, 180 days to close. So practically, if you're doing a 1031, you really need to be doing it simultaneously. Otherwise, people end up overpaying for property. It's like, the last day, something like that. But here's some of the things I just want to talk about, some of the more nuances that we deal with sometimes. So entity issues, right? So for example, we had a long conversation with someone that inherited a fractional interest of a limited partnership that's owned some property forever. He wants out, but he wants to do a 1031. Well, you've got a big problem because you only own a fractional interest of a limited partnership or an LLC or corporation, same thing. If you sell that, like you buy out to another co-owner or you find someone on the open market to buy it, you cannot 1031 that now because you're not selling property, you're selling shares in an entity. So how do you work around that? Well, if it's a sole member LLC, that's fine. Like you own the LLC, that's fine, because the LLC has to buy the next property. If all members of the LLC or the LP are into it, great. You sell that Newport Beach property, you all go buy a property in Texas, and you keep all the ownership and stuff the same, great, that works. But usually the situation is one party wants out. So there is something called a drop and swap. you got to be a little careful of the step doctrine, which we'll probably talk about in a little bit. But obviously, if you do it in one big transaction, you're going to have a lot of trouble. Like, for example, you each own a third of the LLC. You take the LLC, you put it into your individual name. So I own a third, Bob owns a third, Joe owns a third. Now we sell it. Now I can take my third and 1031 it. I can do that. It works on paper. But if I did that the day before the sale, they can kind of look at that and say, no, that's really the LLC or the LP that sold it, and I'm not going to give you credit for that. So there's some case law on that in your materials, and if we get a chance to talk to it when we talk about the step doctrine. So if you are dying to get out of a limited partnership or an LLC, and you're dying to do it in the form of a 1031, you need to get that property into individual names ASAP, or individual LLCs or something like that. You need to do the drop immediately and then wait to swap, okay? Not to be confused with well, we'll talk about that in a second. Okay, timing traps with the reverse 31. Vacant property, this came up the other day. What about a vacant property? I inherited a property 10 years ago and it's just been vacant. I'm like, what do you mean vacant? Vacant. I haven't done anything with it. It's been sitting there for 10 years. They're like, can I 1031 it? I had to think about that for a second. And it basically all comes down to the intent, right? The investment intent. So if you could prove that you were holding it for investment purposes, maybe you can hold things for appreciation. It's not the best thing. There's a safe harbor rule that we'll talk about in a second. But it's really gonna come down to intent. I mean, if you were just holding it and like letting the grandkids crash there or using it as a party house or something like that, that's not gonna fly. But if you were just literally biding your time, waiting for the market to appreciate, maybe saving money to do a bunch of improvements or something, it could work. But it's really gonna come down to what was the intent of the property as long as you had it. So that was an interesting one. Another fun one that we deal with a lot of time is using a 1031 on a primary residence. So remember we talked a second ago, or maybe I said 1031s can only be used for rental property. It's gotta be a business purpose. But remember the old rule of the primary residence used to let you do that for a primary residence. So there is a way to sort of marry these two rules, but it takes a little bit of time and patience. I call it the Hawaii condo hypothetical. So basically the IRS has a nice safe harbor provision, which basically is giving you certain criteria, which are right here. And it's basically 2 years on each end. So the IRS says, hey, if you use it for business investment purposes for 2 years before you sell it, I'm good with that. And then if you use it for 2 years after you sell it, I'm good with that too. Now, you peel back the onion on this, it says basically it has to have been owned for the 24 months. It has to have been rented for at least 2 weeks per year. Oh, do I have another part in there? It's in the materials. It's 2 weeks, 14 days or more, there it is. 14 days or more, and your rental purpose can be no more than that per year. So we convert our property. If we rent it out for 2 years, great, no problem. But let's say we just I don't really want tenants, but I'll Airbnb it for 2 weeks. You could do that. Airbnb it for 2 weeks, leave it vacant 11 and a half months. The IRS is fine with that. Not the best strategy in the world, and you're leaving a lot of money on the table, but that's all they want to see. But then you can't use it for more than that too, right? So you can't just like go use your Big Bear cabin for 11 months out of the year, rent it for 2 weeks and try to get away with it. I'm sure people do that, but you're not supposed to. So they really want to see it being a rental for 2 years. And then the same thing on the opposite end, right? So now we sell our house, we buy that Hawaii condominium that we really want to move into in a few years. Same thing. Now we're going to Airbnb that out for 2 weeks a year, not going to use it personally for more than 2 weeks per year, or we're just going to rent it out long term. Now after the 2 years, IRS is good with us doing whatever we want with it. So now I've taken my primary residence, converted it to a rental, sold it, used that as a rental for 2 years, now I can move into it. So this has taken 4 years. A lot of people don't have the patience for that, but if you're looking at some sort of enormous capital gains consequence, and you know you want to buy a Hawaii condo to retire in, 4 years isn't that much time. And sometimes this works as a hybrid, because maybe someone's already had their property rented out for a year. Oh, great, you're getting closer, right? Or maybe they fully intend to rent out a property for a couple years because they're going to go on a 2-year worldwide cruise or something. So, it doesn't have to be the 4 years. There's situations where it might be a lot less time. And we've definitely had people take advantage of this to not necessarily have those enormous capital gains. This comes up a lot too. Well, what about renting, using a 1031 and renting to kids? You can do that. There's no rule that says you can't rent to your children, but it's got to be at fair market value. So if you've got a property that would normally cost someone $5,000 a month and you're renting it to your kids for $1,000 a month, that's not going to work. You could do that. Maybe there's a gift issue, but it's not going to work for the IRS purposes. So you got to do it at the full fair market value. So put your kids on that lease, have them pay the full fair market value. But remember, you've got those $19,000 a year allowances. Give them some cash on the back end, write them a check, but make sure that money's coming into your account on the rental and on the lease. And you can do that. Okay, what else you got? 1031, so Delaware statutory trusts, I don't want to spend a lot of time on that. People use these for boots. It's kind of like this weird thing where let's say you're selling a property, you do a 1031, but you don't want to buy another property. Well, you can buy into these funds called Delaware statutory trust, and they're basically like funds, right? Like a big mutual fund or something. It's really a bunch of investors that have pooled their money to then buy real estate. So you're buying, it's like a REIT, right? Like a real estate investment trust. So you're buying into a fund that owns real estate. Some people do that, but especially with the boot, this is where we see it most of the time. So let's say you sell that $2 million investment property, but the Hawaii condo you want to buy is only $1.5 million. I've got $500,000 left over. I don't want to pay taxes on the boot, so I can put that $500,000 into a Delaware statutory trust. Don't pay taxes on it. Maybe, hopefully, it's going to appreciate. Installment sales and opportunity zones. I do want to talk about that. I think we're all familiar with installment sale. Obviously, you can do a seller carryback. This works a lot of times with family. This works on the open market too. Why on earth would you do it on the open market? The only times I ever see it are you don't have any other option, right? There's no better buyer that comes along. Maybe a buyer's willing to pay a premium. Maybe they're only doing a 1 or 2 year note. Okay, so usually, at least in the world we see, people aren't doing it for tax reasons. They're doing it because they don't have any better options. But in theory, you can defer or spread out the gains, right? So instead of owing that big giant lump sum payment, or maybe you're afraid it's going to put you into a new tax bracket or something like that, you want to get the payments over time. So that happens. There was a whole presentation last month on structured installments. So instead of the buyer actually loaning you the money, the buyer comes up with the money, and then it basically gets put into like a mutual fund or like a structured settlement, and then you can get guaranteed payments over time, or you can accept more risk and get a little more potential return up and down with the market. But what I really want to talk about was opportunity zones. Now, these are kind of phasing out, but they might be getting a whole new invigoration. This came about in the 1997 original Trump tax cuts. A lot of people still don't know about these. So basically, what is an opportunity zone? So they basically came together and said, hey, we're going to identify a lot of distressed areas, places that need a shot in the arm for revitalization, places that are maybe historically underlooked. We've actually got a bunch here in California. We've got one in Costa Mesa. We've got some in Santa Ana, some in Long Beach. We actually have a multi-unit property in Long Beach that would qualify for this. There's a ton of them, right? You look at the map, it's huge swaths of the country. And basically the deal is that if you invest in these areas that need investment, you're gonna get a big tax break. And the way it works is they create a fund, so you can do it on your own. You can buy a duplex in one of these zones, fix it up. The trick is that you have to put like 50% of the money into it. So let's say you buy $1 million duplex, but the actual structure itself is worth $300,000, right? You got to put $300,000 more into it. You can't just hold it, right? The whole point is we want to revitalize these neighborhoods, revitalize the areas. So you can do it on your own, or you can buy into a fund, right? So just kind of like the Delaware Statutory Trust, just like a REIT, there's companies out there that have giant funds, right? Because I'm not going to buy a $40 million shopping mall, but maybe I can buy, a 1/10 of an interest in that or something like that. And then that way you've got professional management, you've got people that theoretically know what they're doing, but it's still a risk, right? It's like buying into any sort of investment. So nothing's guaranteed. But you get enormous tax breaks, and some of them are kind of fading unless they're renewed. But let's talk about it way back when. So the first enormous thing was that you could defer all the gains, and it's only the gain. So remember, on a 1031, you got to take all of the amount of money that you sold the property for and roll it over. With an opportunity zone, all you have to do is take your gain and roll that over. So you can cash out all that initial principal, all that kind of stuff, and just roll over the gain. This also works for stock sales. So we've got some clients in finance that are making 8-figure bonuses, right? Stock sales or things like that. You can do it for these. And the biggest thing off the bat was that you basically then wouldn't pay taxes on your gain until 2026. So not a huge deal now, but still like over a year and a half, you can defer a gain. So I don't want to write the government a $4 million check this year. I'll roll it into one of these funds. I'll write it next year. Now that number is potentially going to expand that we'll talk about in a second. You get a discount, right? So if you hold it for 5 years, you get a 10% discount on your capital gain. You hold it for 7 years, you get a 15% discount. Now you can't do this with the current expiration date. So this part is moot, but if it gets renewed, this is where the kicker is. So let's say you take $1 million You put it into one of these funds, you hold it for 5 years. Now you want to cash out. Well, now you're only going to pay taxes on 90% of that original $1 million. So you're basically getting a 10% tax-free amount of money back, if that makes sense. If you held it for 7 years, you would get a 15% break. So in other words, you would only pay taxes on 85% of your initial gain. But the real kicker is if you keep it for 10 years and then cash out, all of your appreciation is tax-free. You're still going to pay taxes on that original investment. But let's say you invested $1 million into the qualified opportunity zone. Let's say you cash out 10 years from now, it's worth $2 million. That entire $1 million gain completely tax-free. So this was big. There were a lot of people really using this. It became a big cottage industry, but it's kind of tapered off because a lot of these benefits aren't working as much anymore. Do you need a third-party fund? No, you can do it on your own. California doesn't conform though, so you'd still end up paying your California taxes on the gain. Okay, 2 last things, and then I want to do some questions and answers. Bonus depreciation. This was another huge topic under the original tax cuts, got a lot of attention. Bonus depreciation basically meant that it's like accelerated depreciation, right? We've all kind of heard the anecdote, like, oh, if you buy a car that's over 6,000 pounds or whatever, you can write off a bunch of it right away. Well, this basically got put on steroids, and all the way up until 2022, so just till a few years ago, you could write off 100% of a ton of things in real estate. So we had people, for example, buy a vacation property. You're going to rent it out for a little bit of time so that you can use some of these losses. We'll talk about that in a second. You could do accelerated depreciation on the components. So anything that had a life left of less than 20 years. So people were doing these cost segregation studies. They were saying, oh yeah, the HVAC, the floor, basically everything except maybe the land and some of the original wood in there. So you buy, let's say, like a $500,000 Big Bear condo or like Green Valley Lake condo. You get this cost segregation study that says, well, you've got $200,000 worth of appreciated things here. Boom, you could write off $200,000 in that year. Now, for most people, that would only offset your gain from the investment. So if you, let's say you genuinely used it as a rental, you made $50,000 in rental profits that year, well, you could basically pay 0 taxes on that rental profit because you're depreciating it all at once. But where the real kicker came in, and by the way, now it's only 40%, so it's less valuable now, but there is talk of expanding that. Let's say you want more than just offsetting your gains. Well, now let's talk about being a real estate professional, or for a lot of our clients, maybe having your spouse be a real estate professional. If you become a real estate professional, you can now take all of the potential deductions, all of that cost segregation, or even just forget about that, just regular depreciation, and you can use it to offset all of your income. So let's say you make a bunch of money in the stock market or as a W-2 employee or whatever it is, you could become a real estate professional, use all of those accelerated depreciation things to wipe out the other income. And if you sell the property, you don't have to pay that 3.8% net investment tax. This is huge, but it's hard to qualify. In fact, most people probably can't. So we get a lot of people that have maybe their spouse or their significant other or someone can do it. Basically, more than half of your time has to be spent in the profession or the property trader service, 750 hours, which is kind of a lot. I think it's like 12 hours a week or something like that. And in addition to that, you have to be materially participating in the property. So just owning rental property isn't going to cut it. But if you're a flipper or an investor, or you own a bunch of rental properties and you spend a bunch of time managing them, this was huge, right? Get that designation, get that accelerated depreciation, and people were writing off hundreds of thousands of dollars on their taxes. So this is enormous. What's next? So we've got the big, beautiful bill. Unfortunately, no change thus far in the 121 exemptions that we talked about. So that $500,000 is unfortunately staying put. They are looking at raising that estate tax allowance to $15 million and then pegging it to inflation, kind of making it permanent. Because right now, that number, we talked about the 13.99 million, that's going to go way down if they don't change it. So this would keep it at 15 million. They're talking about extending the opportunity zones. So that's a big one for some of your clients. The biggest one probably for most ordinary people is coming back to the SALT deductions. So remember a while ago, your state and local taxes, your property taxes, the biggest one for most people, we were capped at being able to write off only $10,000 in property taxes. And that may be a lot, especially if you own your home for a long time and you've got a $5,000 a year property tax bill. But if you just bought a $3 million house and you're paying $30,000 a year in property taxes, it's kind of annoying to now be capped at $10,000. So this current form of the bill is adjusting it up to $40,000. So that would be huge. So basically for anyone that's a homeowner, it might make you reconsider itemizing your taxes. It's probably going to give you a big break. Mortgage interest deduction staying put, 1031 staying put, qualified business income. This was a thing that actually works for attorneys and real estate professionals. Basically, you get to write off 23% of your gains up to a certain amount. Like it phases out if you make too much money. But if you're a professional, as we all are, this is actually a personal thing that you could look into. And you probably already take advantage of it on your taxes. Okay, well, that was a lot. Kind of want to talk about Prop 19. I don't know if we're going to have a lot of time for that. Any questions on anything we've talked about so far? And then maybe we'll get into a few things. Oh, no questions. Okay. We're going to do like 4 minutes on Prop 19. So unless you've been living under a rock, Prop 19 is a huge change. I'm not going to spend too much time in it. I think it's been beat to death. But what I did want to talk about was a couple things that we've seen. First of all, the valuation, everyone's heard of that $1 million number. It's actually been adjusted to $1,044,000 and change. It gets adjusted every 2 years. So the powers that be apparently have determined only $44,000 in inflation over the last 4 years. It's got to be the primary residence of the child. If they later move out, it gets adjusted. Some people still just don't know how this works. Basically, you do get a blended rate for anything above the million. The easiest way we've come up, there's like a formula that we've put here that works. But basically, if you've got like that $4 or $5 or $6 million house, the easiest way to think of it is, well, you're going to get basically $1,044,000 off of the basis. So property taxes are 1% per year, so it's still going to save you $10,000 a year. But if your property taxes went from, grandma or mom was paying $4,000 and now you're going to pay $40,000, yeah, this could give us a discount to $30,000, but it's still an enormous increase for most people, which is kind of forcing the sale of the property. This is what I want to talk about. I had an estate planning attorney literally just the other day confide to me that he dropped the ball on this because people still don't understand the deadlines. So there is a very, 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 very strict 1 year deadline when it comes to this Prop 19. So the child has to move into the property. It's a trap, right? California, so it's a trap. The child has to move into the property within a year. No exceptions whatsoever. If the child moves in 13 months after the death, you are completely out of luck, 100%. But the other little known annoyance of this is that you have to file that homeowner's exemption form within the year. Now, if you move in within the year and file the homeowner's exemption form late, let's say at year 2, you will still get prospective relief. I'm saying that right. You will get reassessed for the 2 years in which you did not file the form. But once you file the form, you will now get the property taxes reduced and get to save the money going there forward. Whereas the actual claim for exclusion is a 3-year deadline. So you can move in, file the homeowner's exemption within a year, and then as long as you file the claim for re-exemption within 3 years, you'll still get 100% of the benefit. You'll probably end up getting a property tax bill higher and pay the difference in the interim, but then it'll come back down. A lot of people missing this. We've had multiple calls. I wasn't told I need to file the form. For a while, some counties didn't even have the form on. Orange County didn't even have the form online for many, many, many months. You had to like call and get it. It's online now. But this is probably the biggest malpractice trap, I'd say, for those of you practicing in this area to be aware of. That form and the move-in have to be filed within a year. Yeah, you get 3 years to file the other one, but why on earth would you wait, right? So just file them all together. Get it all done in a year. So if someone comes to you and says, Mom died December 12th, you better be circling like December 1st on the calendar of the following year to make sure you get all that paperwork in. I talk about how the California Realtor Association sponsored this bill. A lot of people don't realize that. It's still very, very slimly passed. We've got an LLC workaround. You're telling me there's a chance. This has been getting a lot of headway. Basically, the rules with LLCs are different. I've got some stuff in the handouts. We'll talk just for a minute. If you originally purchased the property in an LLC, it's not going to get reassessed unless and until more than 50% changes control. If you transfer the property into an LLC later, it's going to get reassessed once cumulatively 50% changes hands. So you got to work your head around that. So you want to buy directly in an LLC if possible, but most people didn't. So example one, you buy the property in an LLC, you leave it to 2 children, it's not going to get reassessed. Each child gets 50% ownership, not more than 50% control has changed hands, therefore no reassessment. But if you have this same hypothetical where mom and dad own a house right now, we're going to put it into an LLC and then leave you 50% each, well, you're going to get reassessed because now cumulatively more than 50% has changed hands. So assuming you don't have a time machine, you can't go back in time and buy it in an LLC originally, well, what on earth can you do? We've got the on-paper success here of sort of the example. It's basically splitting it up, right? So you take the property, you put it into the LLC, no reassessment, give away 50%, no reassessment, put it back into individual names, no reassessment. Now we can transfer a teeny tiny portion to the child, say for example 1%, 1% each parent. Well, that 2% is now going to get reassessed. But now we put it back into an LLC, 24, 24, 52. Parents give the remaining 48% to the child, no reassessment. Everyone follow that? We've got a great illustrated example here. This is sort of a dicey hypothetical workaround. On paper it works, but we have a big problem with then the step doctrine, so it can be viewed as one transaction. The government basically says, hey, that's cute, bonus points for creativity, no dice, because what you've obviously done is you've done a bunch of little baby steps that have clearly all done an end run around Prop 19, and therefore I'm going to reassess you. So this was kind of like when we talked about the LLCs and 1031s. They've got a certain test. They're going to look at, did you basically try to do this to game the system, or was there some valid purpose? So if you can come up with a valid purpose, like especially for that first step or first phase, maybe we'll call it, hey, I want to give my kids 50% now to take advantage of the high tax allowances. I want my son to become part of the management structure, or whatever it is. Maybe that's a great legitimate reason to have gifted away 50%. Maybe 5, 10 years later, you decide, you know what, now the tax laws are great, I want to give it all to him. And you do it at that point. So, there's obviously some subjectivity here where, there might be the opportunity for this to really work out. But people that think, oh, I'm just going to chop it up and transfer it and do this, that, and the other, I'm sure people are doing it. But is that really going to play out if you get in trouble? So, and then anytime you gift, you lose the step up in basis. So the LLC workaround, I think it's got a lot of pros and cons, but for most people it's not going to work. But a lot of people like to know about it. This is the other thing we're seeing. A lot of people just aren't aware of Prop 19, so clueless is the last thing we'll talk about. People don't realize, especially with these properties that are going to get reassessed, a lot of people don't tell the county until they go to sell the property. So mom dies, I sell the property, 8 months later, that's when I do the change and let the county know about the death. Well, it might not be a huge number, but the county is going to reassess for that 8 months between the death and the sale, assuming you don't qualify for Prop 19. Depending on the property you're selling and depending on the parent's original basis, that could be a huge number. Maybe it's a $4,000 or $5,000 tax bill, no big deal. Maybe it's a $50,000 tax bill or an $80,000 escape tax bill. I had trustees call me. No one told me about this. Escrow companies aren't talking about it. Realtors aren't talking about it. So you as the trustee need to be very aware of this, because if you just start writing off checks and there's no money left, and then 8 months later you get an $80,000 bill from the county, you've got a potentially big problem. And we've seen people with that problem. Now, is the county going to come after you with an escape tax bill? Maybe. Is it going to show up on the property tax bill, and is the current buyer going to be annoyed because they keep seeing it? Absolutely. So we've gotten that call from the buyers. And they're like, hey, I know the county's not going to go after me for this. They already told me it's an escape tax bill, but it shows up in my bill. It makes me look like a deadbeat, right? I want this off. And so, this is going to become more of an issue. This is where I see there's some things happening. So the good part, Proposition 19, you can transfer if you're 55 and older. Divorce, it used to be that whoever filed first won. They kind of updated the guidance to say that it has to be agreed upon in the divorce. Using both aspects, you can absolutely do this. We've seen people inherit the house, live in the house for a while, get that low property tax basis. Then if you're 55 and older, you can sell it and take that property tax basis with you. So you can absolutely interplay these two rules. But you cannot do the reverse. We've had multiple people get very upset. Hey, I inherited a house. My current property tax basis is actually lower. I want to sell my house, roll it over into the inherited house. You cannot do that because that 55 and older portion requires it to be a purchase on both ends. Same thing, people have said, well, I want to sell my house to my son. You can do that, just like the 1031. There's no rule against selling to children, but you got to be real careful because it's got to be a full fair market sale. If they think you're giving the son a discount, it's not going to work. All right, I know we went over a ton there. Thank you so much, everyone. I appreciate it. And I'll hang out for a little bit if anyone has any questions.